After several months of respite for motorists and the wider economy, how concerned do South Africans need to be about the latest fuel price increases? Could this be the beginning of an upward trend which could derail the slowing down of the inflation picture and, dare I say, the interest rate cutting trajectory? Well, to share her views on these issues, I'm joined by Koketso Mano. She's an economist at FNB. Thank you very much, Koketso, for joining us. So it's almost felt too good to be true that South Africans have enjoyed the level of respite that they have in terms of fuel prices. But that changes tonight at midnight. They're not massive price increases, but how do you see them impacting on the consumer?
Yeah, I think, you know what, any increase, whether it be 25 cents or R1, does take money out of consumers' pockets. However, we do have to note that, yes, this is a month-on-month increase in terms of pump prices. But when you think about the data on a year-on-year basis, we're still definitely in a better spot than what we were, than the one we were in last year, for example. Even when you think about 2023, 2022, that entire period when right after, Ukraine was invaded by Russia, when we had that spike in oil prices and fuel prices followed suit. So we're definitely in a better spot. But yeah, it is a month-on-month increase, nevertheless.
So, Koketso, when you look at the fundamentals of the underlying oil price as well as the rand-dollar exchange rate, what's FNB's expectation around the direction of those two variables and how they might contribute to the fuel price in the coming months?
Yeah, and you would note that the Department of Mineral Resources and Energy did mention in their statement that, the ongoing geopolitical tensions in the Middle East, for example, is not helping the situation around oil prices. And we see that even today with oil prices around $75.5 per barrel. But when we think about the fundamentals, so if we leave out all these risk sentiment issues, the volatility, from these unfolding risk issues, when we think about the fundamentals, we think about demand, global demand for oil. We have seen sluggish demand. Global growth has not been very strong. Currently, the IMF expected to oscillate around just above 3%. So it's not very strong growth, especially if you think about it in the context of the past decade. So we are experiencing very sluggish growth globally. What could help is easier monetary conditions across the globe. The US started cutting interest rates. We have also started cutting interest rates. That's something that supports activity overall and could also support transportation, oil demand, and so forth. But what we're worried about is that the main or largest consumer of oil products, which is China, has also been experiencing a very weak recovery, since lockdown. So the authorities, they have been speaking about stimulus activity or stimulus policy rather, whether it comes from fiscal policy or monetary policy. So we're still waiting for further detail on exactly what sort of stimulus they plan on implementing to try and stimulate demand in that economy. And that could be something that really supports oil prices. But that's the demand side. Then you also have the supply side, right, where we have seen, especially with higher prices, what you see is that producers that have higher margins in terms of making profit also start re-entering the market. We've seen that in the Americas, for example, higher production coming through there, supporting the supply of oil. And this is despite the fact that OPEC Plus, which includes Russia, for example, Saudi Arabia, so some of your major producers are implementing, production restrictions over the period, over the last year, for example. So you do have those supply dynamics coming into play. And I think, the latest decision by OPEC to delay, an increase in output is, signifying the fact that they realize that demand remains relatively weak. So if you were to increase supply, that will only drive the price lower. So I think when we think about the fundamentals, the demand and supply in the market, you dealing with a finely balanced market, right? So what's really driving prices on a day-to-day basis are these risk issues. So I think for now, we can expect oil prices to really oscillate around the 70, 75 range, not really moving out of that range, given just how tightly balanced the market currently is.
Yeah. Koketso, lastly, and very quickly, if you will, should we see further increases in the fuel price over the next coming months, What does this do to the inflation picture? We know that the MPC, the Monetary Policy Committee, is meeting this month and making a call on interest rates. And the governor always tells us that they look at what they expect to happen in the forward months. Do you anticipate, despite what we're seeing and perhaps an anticipation of a higher trend, that the Reserve Bank will still cut interest rates by a further 25 basis points?
You're so right to highlight the inflation trend and how the Monetary Policy Committee is thinking about it, because if you think about the last few prints, fuel deflation and slower transport inflation has been really supportive of lower headline inflation. But there have been other factors that have been supportive of lower headline inflation. The most important one, given the weight that it has within headline inflation, is core inflation, which is your underlying dynamics, which shows you that demand is not very strong in this economy. So that remains very weak at around just over 3%, for example. Then you also have your food prices, which also have not been very strong if you think about where we come from. Yes, there is monthly pressure there, but we are still benefiting from positive base effects, just given the level of last year's food price growth. So I think given the other dynamics that are happening or that are taking place in the headline number, we still see headline inflation decelerating over the remainder of this year. Maybe if fuel prices rise significantly, it won't be at that 3.5% handle, but we still think that there is still room for the Monetary Policy Committee to continue cutting interest rates, especially if fuel prices do not lift very significantly, and we just have not seen that yet.
Yeah, we do hope so. Thank you so much, Koketso Mano. She's an economist at FNB.